Hello my dear friends and pizza lovers and finance enthusiasts. Welcome back to my channel. Today I'm going to take you into an exciting journey into the world of financial ratios using a delicious example. Pizza. Yes, we'll be exploring some key financial metrics and ratios by imagining a fictional pizza company called Tasty Pizza. So get ready to take a bite out of financial analysis as we dive into these yummy numbers. And this is Sundar and you are watching Mindful Finance. Before we dig into these ratios, let's quickly understand what they are and how they can help us evaluate companies' financial performance. The financial ratios are like secret ingredient that provides valuable insights into companies' health, profitability, and overall efficiency. So just like how each pizza slices can tell us about the whole pie, these ratios paint a complete picture of the company's financial story. So let's get into the details of different ratios. In overall, we are going to cover everything under three types of ratios. The first one is liquid ratios, where we are going to talk about current ratio and quick ratio. The second category is profitability ratios, where we'll be talking about gross margin, net profit margin, return of equity, and operating margin. The third one is solvency ratios, which is debt to equity ratio. The fourth and final one is market value ratios, which is the most important thing to consider for our investing purpose, which are return on investment, your EPS, price to earning ratio, and price to book ratio. So these are the high level we are going to cover in this entire video. We'll go step by step, and as I mentioned, we are going to take an example of a pizza company, so that it will be easy for you to understand, relate to some simple example. So let's get into that. Before jumping, you understand the basic, which is market cap. What is market cap or market capitalization? So let's take an example of our Tasty Pizza, which is a publicly traded company, which means it has sold its shares of its ownership to the public, and those shares are traded on the stock exchange. The market capitalization of Tasty Pizza is like the value of entire pizza shop. Let's break it down step by step, which is first one is shares. Okay. So imagine a Tasty Pizza is a publicly traded company, which means it has sold its shares of its ownership to the public, and those shares are traded on stock exchange. The market capitalization of Tasty Pizza is like the value of the entire pizza shop. So let's break it down step by step. The first one is shares. When Tasty Pizza became a public company, it issues shares to investors. Each share represents a small piece of ownership in the company. The second is share price. The share price is the current value of one share of a Tasty Pizzas. Let's say the share price is 50 rupees. The third one is outstanding shares. The number of outstanding shares is the total number of shares that have been issued and are currently held by investors. Let's say Tasty Pizza has 10 lakh outstanding shares. The fourth one is market cap calculation. To calculate the market cap of Tasty Pizzas, we multiply the share price by the number of outstanding shares. So the market cap will become share price into number of outstanding shares. So in our example, 50 rupees into 10 lakh shares, which would be 50 lakh rupees. So the market capitalization is 50 lakh rupees. So this market cap helps us to compare the size of different companies. If we have another pizza company, say Yummy Pizzas, with a share price of 100 rupees and 500,000 outstanding shares, its market cap would be 100 rupees into 500,000 shares, which is again 50 lakh rupees. Now we see both Tasty Pizza and Yummy Pizzas have the same market capitalization, which is 50 lakh rupees. This means the market values both companies equally, even though they have different share price and different numbers of outstanding shares. I hope this simple explanation would have helped you to understand what is market capitalization, because this is our basic to start with. If you have any questions, you can post your comment. I can try to answer to that. Now let's explore the market caps. In our market, we have three types of segments, which is large cap, mid cap, and small cap. The market capitalization over 20,000 crore is called large cap. The mid cap market between 5,000 and 20,000 crore. The small cap is less than 5,000. Now let's delve into our first section, which is liquidity ratios, and we'll get into current ratio first. So current ratio is liquidity ratio that measures a company's ability to meet its short-term financial obligations. It compares a company's current assets to its current liabilities. Current assets are assets that are expected to be converted into cash or used up within 1 year, while current liabilities are obligations that are due within the same period. By comparing these two figures, the current ratio helps us assess whether a company has enough short-term assets to cover its short-term debts. So basically, the formula for current ratio is current assets divided by current liabilities. So let's take our example, our company called Tasty Pizza. Assume that Tasty Pizza has current assets as 200 rupees and its current liabilities is 100 rupees. Current ratio is 200 divided by 100, which is 2. The current ratio for Tasty Pizza is now 2. This means that company has 2 rupees in current assets for every 1 rupee in current liabilities. The current ratio above 1 indicates that company has more current assets than current liabilities, which is generally considered a positive sign, and it suggests that the company has sufficient short-term assets to meet its long-term obligations. And assume that if the current ratio is significantly above, which is way like more than 1, which is 2 or higher, which indicates a strong ability to cover short-term debts, which may be attractive to investors and creditors. However, a very high current ratio might also suggest that company is holding too many idle current assets, which may not be most efficient use of resources. So they are just idle and they are not using it efficiently. On the other hand, when the current ratio is below 1, suggests that company does not have enough current assets. So this could indicate liquidity issues and raise concerns about the company's ability to meet its short-term obligations. If it is less than say 0.5 or lower than that, which is potentially a distress signal, you need to be careful on that company. So the next ratio is called quick ratio, and also it is known as acid test ratio. It's a more stringent measure of a company's short-term liquidity compared to the current ratio. It focuses on the company's ability to pay off its current liabilities without relying on the sale of inventory. So most of us in our India, the inventory is being considered as a liquid asset, and they feel like it can be sold out at any point of time, but it doesn't work in that way quickly. So the quick ratio excludes inventory from the current assets because inventory can sometimes be challenging to convert into cash quickly. Therefore, the quick ratios only considers the most liquid current assets, which typically include cash equivalents, marketable securities, and accounts receivable. The formula to calculate quick ratio is current assets minus inventory divided by current liabilities. So let's continue using our Tasty Pizza's example and assume that the company's inventory is 50 rupees. So the current assets excluding inventory would be 200 rupees minus 50 rupees, which is equal to 150 rupees. So let's continue using the Tasty Pizza's example and assume that the company's inventory is 50 rupees. So current assets excluding inventory would be 200 rupees minus 50 rupees, which is equal to 150 rupees. So assuming the same current liabilities of 100 rupees, let's calculate the quick ratio. So quick ratio is equal to 150 rupees is current assets minus inventory divided by 100 rupees, which is current liabilities. So our quick ratio comes around 1.5. So the quick ratio for Tasty Pizza is then 1.5. This means the company has 1.5 rupees in highly liquid current assets excluding inventory for. So let's interpret the quick ratio above 1 indicates that company can pay off its current liabilities without relying on the sale of inventory. So they don't need to sell anything in their inventory. So and it suggests that the company has enough liquid assets to cover its short-term obligations promptly. With a quick ratio significantly above 1, which is say 1.5 or higher, which indicates strong ability to meet short-term debts using highly liquid asset, and which is generally considered as a positive sign. And if it is less than 1, which suggests that the company may face challenges in paying off its current liabilities without relying on the sale of the inventory. This could be a cause for concern for investors and creditors. Now let's get into the next level, which is profitability ratio. So in the profitability ratios, we'll be covering gross margin, net profit margin, return of equity, and operating margin. So let's see what is gross margin. The first one is gross margin, which is also known as gross profit margin. The financial metric so that a company's profitability from its core business operations. If you take an example of Infosys, their core business operation is coming from service industry, service company. If you take Tata Motors, their core revenue is from manufacturing cars. So that way it indicates how much money a company makes from its revenue after deducting the direct costs associated with producing or delivering its goods or services. The formula for calculating gross margin is gross profit by revenue. Gross profit divided by revenue into 100. So where gross profit is equal to revenue minus cost of goods sold, which is COGS. So revenue minus cost of goods sold. So let's take our example, Tasty Pizzas. Assume that the Tasty Pizza generated a revenue of 500 rupees during the year and its cost of goods sold, which is COGS, which includes ingredients, labor costs and other directly related costs to make the pizzas. So assume that amount is 200 rupees. So let's first calculate the gross profit. So gross profit is equal to revenue minus cost of goods sold, which is equal to 500 rupees minus 200 rupees. So your gross profit is 300 rupees. So now let's next calculate the gross margin. So gross margin is equal to gross profit divided by revenue. Gross margin is equal to 300 rupees divided by 500 rupees into 100. So ultimately gross margin is 60%. So the gross margin for Tasty Pizza is 60%. So this means that for every rupee of revenue the company generates, it keeps 60 paise as gross profit after deducting the direct cost of producing the pizza. Let's see how to interpret this gross margin. A higher gross margin indicates that the company is generating more profit from its core business operations. So it suggests that the company has a good control over its production cost and is effectively pricing its products or services. A lower gross margin may indicate that the company is facing higher production cost or may not be effectively managing its cost of goods sold. So comparing the gross margin with other companies in the same industry or like peer industries can provide insights into the company's competitiveness and efficiency in its operations. For example, if you compare Tata, TCS and Infosys, they are the same company, and check how their gross margins are, and Tata Motors and Maruti Suzuki. Compare them and understand what is the gross margins are. To understand this, how to find out the GPM, so you can use screener. So you can find companies which are trading the good GPM. So if you want to do, go to screener.in. From the screener.in, go to screens. So you will find a lot of screens over here, but let's create from by ourselves. You can see the condition how to write. For example, this is market capitalization is greater than 500 crore. So let's take this as an example. And instead of 500 crore, let's say 5,000 crore for our. So market cap is greater than 5,000 and our GPM, which is greater than say 65. Yummy Pizza's GPM is 65%. So I'm taking that as an example for now. Let's say run the query. You see you are getting 255 results. So market cap more than 5,000 and GPM more than 65% is the criteria. So this is the GPM percentage. You can start by this one. You can see the maximum is 201, which is Brigade Enterprises. So using this, you can filter out the stocks and you can compare with the other ratios as well. Not just the GPM. GPM is a one parameter, but you have to compare with all the parameters. I'll show you one more example. If I increase this market capitalization, which is 50,000 crores, if you see the GPM, which is 100, maximum it is beyond or more than 70 and 80s, and also is more than 100. So these are actually large cap companies. So large cap companies are mostly, they'll have a good GPM. So the GPM you need to check when you are checking for small cap companies or micro cap companies. So you can check for GPM. GPM, current ratio and quick ratios are very important for the mid cap and small caps criteria. Because in the other case, in the large cap, most of the things would have already satisfied. So you don't need to worry about that. But when you're considering for the micro caps and small caps, please look into these ratios. So the next ratio from the profit ratio is net profit margin. So net profit margin is another financial metric that measures a company's profitability, but it takes into account of all expenses, including operating expenses, interest, taxes, and other costs, in addition to the cost of goods sold. So net profit margin provides a clear picture of how much profit a company is earning from its total revenue. So the formula for calculating the net profit margin is, so net profit divided by revenue into 100. So where the net profit is equal to revenue minus total expenses. Let's use our Tasty Pizza's example over here. Assume that Tasty Pizza has total expenses of 250 rupees, which includes the cost of goods sold, which is COGS, of 200 rupees, and other operating expenses like rent, salaries, utilities, etc. First, let's calculate the net profit. So net profit is what? Revenue minus total expenses. So our net profit is equal to 500 rupees, which is our revenue, minus 250 rupees, which is the total expenses. So the net profit comes around 250 rupees. So next, let's calculate the next net profit margin. So net profit margin is what? Net profit divided by revenue into 100. So net profit margin is equal to 250 rupees divided by 500 rupees into 100. So our net profit margin comes 50%. This means that for every rupee of revenue that company generates, it keeps 50 paise as net profit after deducting all expenses including cost of goods sold and operating expenses. So how to interpret net profit margin? Higher net profit margin indicates that a company is efficient in managing all the expenses and generating significant profit from its total revenue. It also suggests that the company has good control over its cost and is running profitable business. The other side, if it is lower net profit margin, which indicates that the company is facing higher expenses or may not be effectively managing its cost, resulting in lower profits. In this, the next one is ROE, but before getting into the ROE, we need to have some basics of market-based ratio. Let's get into the market-based ratios first and then we'll come back here. So our market-based ratios are ROI, EPS, PE ratio and price to book ratio. So let's start with EPS first, which is earning per share. What is earning per share? So let's take our example of Tasty Pizzas. And this pizza company, I'm going to start with my friend. In that, so each person invested some money and got an equal share in the company. So assume that there are 10 slices of pizza in total. So each slice represents one share. At the end of the year, your business Tasty Pizzas made a profit of 100 rupees. So to calculate the EPS, you divide the total profit by the number of outstanding shares, which is equal to 100 divided by 10, which is 10 rupees per share, which is per slice. So now let's say you and your friends own different number of shares. So let's say you own 3 slices of the pizza and your friend Aisa owns 2 slices of the pizza and your friend Ben owns 5 slices of the pizza. So when I say slices, it's assume that it's a share. So to find out how much profit each of you made individually, you can simply multiply your shares by the number of count of the shares. How do you calculate your profit now? So your profit is, you own 3 shares. So 3 shares into 10 rupees per share, which is equal to 30 rupees. And Aisa owns 2 shares, so her profit is 20 rupees. And Ben owns 5 shares and his profit is 50 rupees. So you earn 30 rupees from your ownership in Tasty Pizzas during the year. And Aisa earned 20 rupees and Ben earned 50 rupees. So few scenarios I'll try to show some formulas because those are the very important thing to understand. Those things I'll cover in detail. Others I'll try to cover it through Screener. So you can check screener.in for more details. So let's take an example of Avani Supermarket and find out how to calculate the EPS for Avani Supermarket. The formula for Avani Supermarket or anything, right? Formula for EPS is you should know the net profit after tax, your market cap, your current price and number of outstanding shares. So how will you find out that? So come to the Avani, the screener.in. This is your market cap. You can find the market cap over here. Current price is 3,652 and the net profit is, you just scroll down, you will find out profit and loss statement. So you will find out net profit, which is 2,394 crores. To find the number of outstanding shares, the formula is market cap divided by current price, which is market cap divided by current price, which is 65. The total number of outstanding shares will be 65. So now the formula for EPS is net profit after tax divided by number of outstanding shares. So net profit after tax is 2,394 and the number of outstanding shares is 65. So if you divide, you will get 36. So come back to our screener. If you come over here, you can see the EPS value over here, which is 36.9. So this is how you will find EPS. So earnings per share. As a shareholder, per share, the company is able to get you 36.9 rupees. So your EPS is for Avani Supermarket, you can find out the EPS is 36.9. So during the year, by owning a share with Avani Supermarket, you are able to earn 36.9 rupees. The next ratio is going to be a very important one, which is PE ratio. So you would have heard about this PE term in multiple times. This is a very important ratio, which is called price to earn ratio. This is being used for identifying the stock as whether it's undervalued stock or overvalued stock. So let's take in our example. So in the previous example, we calculated the EPS for our Tasty Pizzas, which was 10 rupees per share. So let's say that the current market price of the each share of Tasty Pizza is 50 rupees. So to calculate the PE ratio, we divide the market price per share by the earnings per share, which is EPS. So PE ratio is equal to market price per share divided by earnings per share. So in this case, what is our PE ratio? 50 rupees per share divided by 10 rupees per share, which is 5. So our PE ratio of Tasty Pizza is 5. So this means that investors are willing to pay 5 times the company's earnings per share to buy one share of the company's stock. Hope you understood. I'm repeating it again. This means the investors are, so when the PE ratio is 5, which means the investors are willing to pay 5 times the company's earnings per share to buy one share of the company's stock. So what it suggests that the market values Tasty Pizza at 5 times its earnings. So generally, a higher PE ratio indicates that investors have higher expectations for the company's future growth and are willing to pay a premium for its stock. And similarly, if a lower PE ratio means it indicates that market has lower expectations for future growth or the stock is undervalued. So that way you can check the stocks based on the PE. So let me show you the PE calculations over here. Let me take the example of Avenue Supermarket. So what is the formula for PE ratio? Market price per share divided by earnings per share. So let's see what is the market price of the share. Market price of the share is 3,652 rupees. What is the EPS then? We checked the EPS earlier. What was that? 36.9. So 36.9 is our EPS. So it's very simple, right? You just divide 100 divided by 37, which is 36. So let's see how to calculate the PE for now. So PE ratio is something you have to calculate by current price divided by EPS. That is our formula, right? If you see, market price is 3,700 or 3,652 rupees. So when I was doing this, it was 3,700 and EPS is 36.8. So if you divide 3700 divided by 36, approximately your PE ratio will be 100. So if you come and see the Avenue Supermarket, you can see PE is 99. Now whether this is overvalued or undervalued, which you have to do some kind of analysis to compare with the peers and everything, you have to understand whether it is overvalued or undervalued. But I can give a small tip to you to do this. If you scroll down, you can see this chart over here. So default it will be price chart. You can enable the PE chart. If you see the PE value, you can see a line crossing over there, which is the average PE for Avenue Supermarket. And if you see, this is below the average. So now you can decide whether it is undervalued or overvalued. By this also you can, using the PE data, you can find out whether it's undervalued or overvalued. Now coming back to the next ratio, which is price to book ratio or PB ratio, which is another very important ratio. So we need to know the book value per share for the company and the current market price per share to understand price to book ratio. The PB ratio compares the market value of company shares to its book value, which is the value of the company's asset minus its liabilities. So let's get to the details about that. Take our example for Tasty Pizza. So let's assume that the book value for the company is 300 rupees, which is total assets minus liabilities. The number of outstanding shares, which is slices, is still 10. So to calculate the book value per share, we divide the total book value by the number of outstanding shares, which is 300 rupees divided by 10, which is 30 rupees per share. So now let's say the current market price of the each share of Tasty Pizza is 50 rupees. So to calculate the PB ratio, we divide the market price per share by the book value per share, which is 50 rupees per share divided by 30 rupees per share, which is equal to 1.67. So the PB ratio for Tasty Pizza is approximately 1.67. This means that market values the company's shares at 1.67 times its book value. So let's see how to interpret the PB ratio. Just concentrate over here to understand what is this PB ratio. If PB ratio is less than 1, indicates that the market values the company's shares at less than their book value. It could suggest that the stock is undervalued. And if the PB ratio is greater than 1, indicates that the market values the company's shares at a premium compared to its book value. It could suggest that the stock is overvalued or that investors have high expectations for the future growth. So PB may be high due to certain reasons. So don't just go with the since PB is less, that is undervalued. You have to compare other ratios also. So now let's see the PB ratio for Avenue Supermarket, how it is. What is the Avenue Supermarket's PB ratio? Where is this? Price to book value, which is 14.7. How it was arrived? Let's get into that. If you check the PB ratio formula, which is market price per share divided by book value per share. So market price is 3,700, book value is 248, PB is 14.9. So simply you can come and check the book value over here, which is 14.7. So this is the book value. Hope you are able to understand how to find the book value screener and understood the concept of PB now. So let's get into the next one, which is another important one. Till now we looked into EPS, PE, PB, and the fourth is very important one, which is ROI. Let's see what is ROI. ROI, or return on investment, is a financial metric that measures the profitability of an investment related to its cost. It helps investors and businesses evaluate the efficiency and profitability of a specific investment or project. So here the formula to calculate ROI is very simple. Net profit from the investment divided by cost of the investment into 100. So let's again go back to our example, our Tasty Pizzas example. Let's assume that the company invested 400 rupees to start the pizza business. And at the end of the year, the net profit was 200 rupees. So using these values, we can calculate the ROI for the investments, which is 200 rupees divided by 400 rupees into 100, which is 0.5 into 100 is 50%. So the ROI of the investment, or the return on investment, is 50%. This means the company earned a return of 50% on its initial investment of 400 rupees. And how to positive ROI, which is greater than 0%, indicates that the investment is profitable. The return is higher than the initial cost. So in this case, a 50% ROI suggests that the investment in Tasty Pizzas was financially beneficial. The negative ROI indicates that the investment resulted in loss. The return is lower than the initial cost. So everybody expects ROIs to be positive. So any company is running with the ROI is less than you should be worried about that stock or particular company, and don't take risk on that. ROI may be temporarily, this might be negative. So it's not the only thing that you have to check for. You have to check other indicators also. Now coming back to our profitable ratios, which is return on equity. Return on equity, or it is called as ROE. So which is financial metric that measures a company's profitability in relation to its shareholders' equity. It shows how much profit a company generates for each rupee of shareholders' equity. ROE is calculated by dividing the net income of the company by its shareholders' equity. Let's continue the example of Tasty Pizzas to calculate ROE. So we already know that the company made a profit of 100 rupees. The book value of the company is 300 rupees. Therefore, the shareholders' equity can be considered as the book value, which is 300 rupees. ROE is equal to 100 rupees divided by 300 rupees, which is approximately equal to 0.33 or 33%. The ROE of Tasty Pizzas is approximately 33%. So this means that for every rupee of shareholders' equity, the company is generating a profit of 0.33 rupees or 33 paise. How to interpret the ROE now? Higher the ROE is generally considered better, and which indicates that the company is generating more profit from its equity investments. It suggests that the company is efficient in utilizing shareholders' funds to generate earnings. A lower ROE indicates that company is not generating sufficient profits, and the company is making losses from your investments. So it's important to note that ROE can vary significantly among different companies and industries. Some industries such as technology and healthcare tend to have higher ROEs, while others like utilities or real estate might have lower ROEs. So due to the nature of the business operations. So but overall ROE has to be more. So let's see what is the ROE for Avenue Supermarket over here. If you come here, you can check ROE, which is 16%. Which means every 100 rupees, company is giving 16 rupees earning. So this is how we will interpret ROI. And the next ratio is operating margin. Operating margin is equal to operating profit divided by revenue into 100. So let's take our example again, Tasty Pizzas. Let's assume the operating profit is 100 rupees. and the revenue is 500 rupees. Now let's calculate the operating margin for it. So 100 rupees divided by 500 rupees into 100, which is 20%. The operating margin for Tasty Pizza is 20%. This means the company retains 20 paise as operating profit for every rupee of revenue generated, or it takes 20 rupees for its operating expenses per 100 rupees. So how will you interpret the operating margin over here? It's very same thing. An operating margin of 20% here in our Tasty Pizza suggests that the efficiency manages the Tasty Pizza efficiently manages its operating expenses and retains reasonable profit from its core business operations. So it indicates that company has good control over costs such as rent, salaries, utilities, and other day-to-day expenses while providing its products or services. So with the inclusion of operating margin, we now have a comprehensive understanding of Tasty Pizza's financial performance. The company showcases efficient operations, healthy profitability, sound liquidity, and reasonable leverage, so making it an attractive investment opportunity. So let's see how Avenue Supermarket scenes here. If we check the operating margin for the quarterly result, you can see OPM, which is 9%. So every 100 rupees, 9 rupees is considered as operating profit by the company. This shows, so basically the company is able to retain 9 rupees per 100 rupees as an operating profit. In this solvency ratios, the debt to equity ratio is a key ratio which is calculated by dividing the total debt of the company by its shareholders' equity. So the formula is DE ratio is equal to total debt divided by shareholders' equity. So let's assume our Tasty Pizza's example where Tasty Pizza has total debt of 200 rupees. So DE ratio is equal to 200 divided by 300 rupees, which is shareholders' equity. So DE ratio is equal to 0.67 or 67%. DE ratio for Tasty Pizzas is approximately 67%. This means that for every rupee of shareholders' equity, the company has 0.67 rupees, which is 67 paise in debt. Higher DE ratio indicates that the company has more debt relative to its equity. A high DE ratio suggests that the company is relying heavily on borrowed funds, which can increase financial risk. High debt levels may result in higher interest payments and could put the company under financial strain. If it faces a problem in not able to pay the debt, this could create a lot of effort or effect in the future. So a lower DE ratio indicates that company has less debt compared to its equity. So a lower DE ratio is generally considered more favorable, as it suggests the company is less reliant on debt financing, more financially stable position. So now you would have learned all the ratios. These are the ratios which I covered in this video are the major ratios you should look into. This ratio is very much enough to pick and understand the fundamentals of a company. This will help you to identify a better stock for your long-term investments and start your mindful investment immediately. Don't wait for anything. So I wish you all the best. If you haven't subscribed my channel, do subscribe and press the bell button to receive my videos on time. Thank you so much.